in the near term, the chart's telling me that we're likely coming down to this 4,300 level, maybe a small bounce, then we'll break down to 3,900 here. Now, again, will that be the bottom in gold or not? 3,500 level, where I am going to be buying long-term positions. And so you might see some sort of event where the stock market really gets scared, and that could be the final drive from 3,900 down to 3,500. And then that's where you start to see the reversion trade and it start to trade back up. As essentially the US financial state deteriorates more and more, bull markets in gold are elongating. Incredible move to $120 per ounce on silver. The massive collapse down to 64, a bounce, then another lower low. That silver is likely going to come down, small bounce, and go even lower. And I'm still looking for sub $50 silver. And I know people don't want to hear that. Oil trade might start slowing the US economy and the global economy. You know, when we got above $100 an ounce in silver, this is getting a little ridiculous. It should pull back. And it still went to 120.
Where I was thinking we could begin is with gold. So we saw at the beginning of the year, the gold price hit all-time highs. Right now, we're in a pullback since the Iran war began. And I wonder if you could start by talking about where you see support and resistance levels for gold at the moment.
Yeah, so the chart's interesting. And before we get to the chart, one of the things I want to just mention is that we've seen this change in gold ever since that rally that basically started at the beginning of the year, the final, what we would call a blow-off top. People started to jump into gold, not because it was a defensive play, but more because it was a momentum play. And anytime you have an asset that is more of a safe haven asset, where it starts to become a momentum play, it tells you that the structure or the reason it goes up or down is now changing. And ultimately, it has to flush down enough until it washes out those weak hands that bought it for the wrong reason. For example, a lot of your listeners bought gold like I did years ago because it's a safe haven. It's a way to protect ourselves against fiat currencies and lots of other shocks. So if we look at the chart, we can see here that we had the big blow off top right here, right? Parabolic move from about the 4,300 level all the way to 5,600. We then got the sharp correction and this sideways inside bar, another correction, and now again a bounce, and we're starting to come in again.
A record-breaking gold rally isn't supposed to reverse right after mainstream momentum buying peaks, yet that's exactly what price action is signaling. As Gareth Soloway points out here, the shift from safe haven demand to speculative chasing marks the exact point where institutional distribution often begins quietly. Gold's drop from a $5,600 blow-off top, despite geopolitical tension, suggests positioning matters more than headlines. If that transition is real, retail is still treating this as protection, while smart money is treating it as exit liquidity. Next, Gareth Soloway reveals why that divergence could be masking a deeper liquidity reset few investors are prepared for.
Really what we're seeing now is high, lower high, low, lower low, right? So essentially we've changed from an uptrend in the near term to a downtrend. And that really has me more skeptical in the near term that gold's going to turn back up and make new all-time highs. Instead, the chart's telling me that we're likely coming down to this 4,300 level, maybe a small bounce, then we'll break down to 3,900 here. Now, again, will that be the bottom in gold or not? That's a good question. I do think that there's potential for a washout later this year back to about the 3,500 level. And at that point, that's where at least I've already isolated down where I am going to be buying long-term positions, right? So again, I remain a long-term gold bull, meaning that if you look at the government spending and what's going on in the world and the fiat currencies and the dollar slowly being devalued and probably slowly de-dollarization as well, it makes sense to buy gold. For me, though, I want to make sure I get it as close to the lows on this pullback as possible. And for me, that's 3,500.
All right. So we'll wait and see, I guess, if that 3,500 level pans out. I wonder, so people, I think, are wondering right now about, we've kind of accepted we're in this sideways moving pattern. Maybe we can go down. I think people are wondering, all right, well, what then breaks gold out of this pattern we're in? For you, is it that we eventually flush out those people who were buying on momentum and we get back to the people who are in it for the reasons you were discussing? Or is there something else at play that you'd be watching?
So I think, and this is the interesting thing, is a lot of the same reasons a lot of people like myself were buying gold years ago and even more recently, those reasons are still intact, right? Again, you look at all the issues that are going on with government spending, and we're talking globally here, the debt loads that are being put on so many countries, so many citizens. So I think the underlying factors are there. It's more that first thing you mentioned, which is that you have this period where investors, generally the investors that buy momentum, they don't have the staying power to stick around in a trade when it gets boring or if it slowly drifts lower. And when they start to unload, it then pushes that sell pressure even more. Now, granted, we could still say you have sovereign nations still buying, Federal Reserve banks are still buying gold. That's absolutely true. But there's still a lot of weak hands that are in gold that could cause it to kind of correct back down. And I would even say that we have to remember that when things get bad, meaning like COVID, remember 2020 of March, even though COVID was the obvious reason why gold should spike, when fear absolutely hit and the panic was in the markets, even gold sold off. And so you might see some sort of event where the stock market really gets scared, and that could be the final drive from 3,900 down to 3,500. And then that's where you start to see the reversion trade and it start to trade back up.
A clean technical reversal into lower highs and lower lows is already showing up in gold's structure before any macro confirmation arrives. As Gareth Soloway points out here, prior cycles show that even safe haven assets liquidate during panic events where margin pressure overrides narrative. That disconnect between fundamentals and price action is where forced selling often begins, not ends. If 3,900 fails, the move toward 3,500 stops being theory and becomes liquidity-driven reality for weak hands. Next, Gareth Soloway exposes the exact cycle stage where this kind of flush typically resets institutional positioning entirely.
I wonder if you can situate us a little bit more in terms of where we are in the cycle for gold. I've been hearing from many people that this bull market isn't over, and it's common to see these types of pullbacks even when you're in the midst of a bull market. So where would you situate us? I think people have a lot of questions given the dynamics we're seeing right now.
Yeah. And it's a great question, right? Because if you historically look at the last bull markets that went from, if we go back to the 1970s here, this bull market, if we look at how long it lasted, from the beginning point to kind of the top out, it was only about 1,200 days, right? So again, you're talking, that was about 3 years of a bull move. And then if we go to the next one, which was the beginning of the run going back to 99, that kind of, you could argue, really lasted until, I guess you could make a case that it lasted until 2011. That was a longer bull market that lasted about 4,300 days. So I would argue this, and this is a very interesting aspect, that we're seeing as essentially the U.S. financial state deteriorates more and more, the bull markets in gold are elongating, right? So if we look at that one in the 70s, late 70s, early 80s, it was shortest. Generally, the U.S. had their fiscal ship in order, right? But when you look at the 2011 top, that was just after COVID when the Fed was really printing the most. We got the biggest parabolic move.
Gold bull cycles are stretching longer each decade, even as volatility compresses into sharper peaks and faster reversals. As Gareth Soloway points out here, historical cycles show that monetary instability correlates with elongated commodity supercycles, not shorter ones. That creates a contradiction. Longer-term bullish structure, but shorter-term violent liquidation phases inside it. If that pattern holds, this isn't a collapse of the bull market. It's a forced reset phase inside a larger expansion cycle. Next, Gareth Soloway reveals why this elongation may actually be hiding the most aggressive phase of the cycle still ahead.
And then obviously what we've seen more recently is arguably, you could make a case that the bull market started maybe at the lows in 2018. I would argue more in 2022, but this one could last, honestly, all the way into 2030 or beyond. And I think that, again, goes to that elongated cycle in these bull markets of gold. And listen, if somehow miraculously the U.S. gets their fiscal house in order and the world starts figuring it out, okay, maybe gold isn't the place to be for the longer term, but let's be fair. What are the odds that that's actually going to happen? I think, again, that longer term cycle is probably intact.
I like that elongation idea because I think even when we were seeing those really high prices at the beginning of the year, everybody was sort of feeling, wow, it doesn't really seem like this is over, even though these are, the top levels of some of the prices people were calling for. I wonder, I wonder if we can also take a look over at silver and support and resistance there as well. It's had kind of a similar trajectory to gold. And I wonder if you see it following what is coming for gold as well.
Yeah, and I do to a large extent. I think, again, we just have to be a little bit more careful with silver as it's obviously somewhat more industrial. And so it has more of a sway based on how the economy is doing. But what we can see is the same thing happen, that incredible move to $120 per ounce on silver, the massive collapse down to 64, a bounce, then another lower low.
A cycle being extended to 2030 doesn't remove downside risk. It actually increases the number of violent reset phases inside it. As Gareth Soloway points out here, silver's industrial link means it reacts harder to liquidity contractions than gold, turning macro slowdowns into sharper price dislocations. That explains why a $120 peak can still coexist with a rapid collapse toward prior consolidation zones. For investors, the danger isn't missing the long-term bull, it's surviving the mid-cycle liquidity vacuum that wipes out leverage first. Next, Gareth Soloway exposes why silver's volatility structure may signal a deeper industrial slowdown ahead.
Another lower high, and you can see again, high, lower, lower, high, lower, high, low, lower, low. So it implies that silver is likely going to come down, small bounce, and go even lower. And I'm still looking for sub $50 silver. And I know people don't want to hear that, but you can kind of make a case for it, right? I mean, here we are in an economy that this oil trade might start slowing the U.S. economy and the global economy. And then also if silver and gold and the metals are going to see a decline from kind of flushing out the weak hands, that combination could easily push us below that $50 per ounce level. And I think that's kind of where I'm eyeing here. On a technical basis, really this zone here, which was that final, notice how we kind of did this little bit of a cup and handle pattern and then broke out. And this would be a resumption or a retrace into that same sort of zone, which should act as technical support around $50. And I know it's amazing because, just earlier this year, we were at 120 on silver, but this is historically, silver is very, very volatile like this.
Well, I think for silver, you're right. I don't think people want to hear that we're going below 50, but maybe it matters how much below 50, because I've heard a lot of people say, well, it can get back to about that level. How much lower underneath 50 do you think it could potentially go?
Silver hitting $120 and rapidly reversing back toward prior breakout zones suggests a classic liquidity exhaustion spike, not sustained demand. As Gareth Soloway points out here, when industrial metals roll over alongside weakening energy demand, it often signals broader economic cooling before official data confirms it. That disconnect between price peaks and real demand is where institutional positioning quietly shifts. If sub $50 triggers algorithmic stops, the move to $40 becomes mechanically driven rather than fundamentally debated. Next, Gareth Soloway exposes the exact threshold where mining economics begin forcing supply-side reactions.
Yeah, and that's always the tricky thing, right? Because to call a spade, when we got above $100 an ounce in silver, that was kind of where I was like, okay, this is getting a little ridiculous. It should pull back, and it still went to 120, right? So I mean, what we know is human nature is to greed or FOMO in at the highs, and then at the lows, that massive panic. So I do think, there's always a chance it goes lower. You could be talking $40 or something in that range, but we have to keep in mind that there is still a deficit in many situations with silver. You still have to mine it, which costs money. And so as costs go up, at a certain point, it doesn't make sense as much. And granted, silver's a lot of that offshoot of gold mining. But for the most part, I would say that sub $50 to $40, that would be the overshoot, would be down to 40. If you think about it, from 100 to 120 was a 20% overshoot. From 50 to 40 would be a 20% undershoot of that level. Either way, for me as a technician, looking at the long-term fundamental aspect, it's kind of like, okay, once we get down below 50, that's where I just start to slowly accumulate those longer-term positions with my main thesis of where things are going being intact.
Yeah.
Silver spiking to $120, then collapsing toward a projected $40 to $50 zone signals extreme liquidity whiplash, not stable demand discovery. As Gareth Soloway points out here, prior blow-off moves of 20% overshoot were consistently followed by equivalent undershoot corrections when sentiment flips. That symmetry exposes how quickly retail FOMO becomes institutional exit liquidity. If price breaches $50, systematic accumulation doesn't begin safely. It begins during maximum fear, when most investors are still averaging down. Next, Gareth Soloway reveals why cost of production support often fails exactly when macro liquidity tightens most.
Yes, really important to keep the broader context in focus as well. Going a little bit beyond the metals, I want to take a look at the Fed because, of course, this week we have the latest meeting. I know that it's very widely expected for rates to stay unchanged this time around, but there's so much else going on in terms of Fed activities. We have the Powell-Warsh transition playing out. So I wonder, what will you be watching most closely, perhaps in the commentary after the meeting?
Yeah, I think the thing that everyone is going to be watching like a hawk pun intended in that situation, but I think the key is, does Jerome Powell tell us, is he going to stay on at the Fed as a governor, or is he going to fully step off? And there's been this lot of back and forth. And the reason why this is important, right? Because you could say, well, if Kevin Warsh is the Fed chair, then what does it matter who the governors are? But remember, it's about a vote. So nothing happens in the Fed without a certain number of governors agreeing that they have to either cut rates, stay pat, or lower rates. And so if you get Powell to stay on, it means that the weighting will be more towards a hawkish Fed versus likely Kevin Warsh is going to be more of a dove, as obviously the President Trump made it super clear he didn't want to put anyone on the Fed chair's position unless they were dovish and willing to cut rates.
Fed policy isn't just about the chair. It's about vote-weighted internal control that rarely gets priced in until after volatility spikes. As Gareth Soloway points out here, even a single governor shift can tilt policy bias between hawkish restraint and dovish expansion without any headline rate change. That hidden power structure means markets often misread unchanged rates as stability when internal alignment is actually shifting. If Powell stays, liquidity expectations tighten faster than retail anticipates. Next, Gareth Soloway exposes how leadership positioning inside the Fed signals future rate direction before any official decision is announced.
So I think for me, that's the number one thing. Is he staying on, or is he going to step totally aside? It'll really tell us a lot about the independence of the Fed as well, which could then let us understand what the long-term implications are if you obviously have the president having more power at the Fed.
Right. So it sounds like from that perspective, it could very well be an important meeting. You talked a little bit about what we can expect from Warsh. I wonder if there's anything else you would add, because of course there is that expectation that he will follow in line with what Trump would like to see, which is lower rates. But it seems like, in his commentary leading up to all of this, he's been saying he's not going to do that. So anything further you'd add?
Yeah, I mean, my concern is that to be confirmed, he has to talk the line, right? So even if he said something in private with the president, and we know how the president attacked Jerome Powell so much for not lowering rates with social media posts and all this other stuff, even an investigation, it does make me concerned that, Kevin Warsh is saying what he has to say to, make sure that he gets the position and gets voted by Congress to confirmed as the Fed chair. But the other thing that concerns me too is when he was testifying in front of Congress for his confirmation hearing.
A Fed chair nominee publicly resisting political pressure while needing political approval creates a built-in contradiction that markets rarely price correctly. As Gareth Soloway points out here, confirmation incentives often force candidates into temporary positioning that may not reflect future policy reality once appointed. That gap between pre-appointment signaling and post-appointment behavior is where rate expectations get mispriced. If independence erodes further, markets won't adjust gradually, they'll reprice abruptly. Next, Gareth Soloway unravels how confirmation era messaging often masks the true policy trajectory, already being negotiated behind closed doors.
He said about changing the way inflation is monitored or how the numbers come out. In other words, what he was saying is that what they need to do, what the Fed needs to do, is throw out any outlier numbers. So let's say oil jumps 30% in a month or 40%. His policy he would want to institute would be to say, okay, we're not going to include that in inflation. We're going to focus on everything that's kind of stable. And that's concerning because as a citizen of the world and of the US, that's not your real true read of inflation. And we know that. And so I think it's a little disingenuous, a little bit of a concern that that's coming up as like kind of like fudging the numbers a little bit. We'll see how it plays out. But again, I am a little concerned until we really see him for a few months as the Fed chair.
That is definitely concerning, especially when there's already questions about how some of these numbers are arrived at. And it's going in a direction I wanted to pursue as well, which is inflation. Since the Iran war began, I think concerns about inflation have really ramped up. And from what I'm hearing so far, it really depends on how long this conflict lasts, what the impact for inflation will be. But anything that you can share on what you see coming for inflation at this point?
Yeah, and I think the biggest thing on inflation is to understand that inflation, if it was a 1 or 2 week or even a month shock of oil going to $100 a barrel, it will have a minimal impact, right?
Inflation data smoothing proposals collide directly with energy-driven CPI spikes, where oil at $100 historically distorts real purchasing power faster than any model adjustment can hide. As Gareth Soloway points out here, excluding volatile inputs risks creating a statistical illusion of stability, while real household costs accelerate underneath. That contradiction between measured inflation and experienced inflation is where policy credibility breaks down. If energy remains elevated, recalibrated CPI could lag reality by months. Next, Gareth Soloway exposes how data cleaning during geopolitical shocks often delays recognition of true inflation pressure.
Because producers can kind of wait that out with inventory and things like that. But now we're going into, month 2, month 3 of oil being $90 plus. There's absolutely going to be a factor of inflation. And remember how inflation works, right? So prices go up for the wholesale numbers, meaning the PPI, producer price index. And eventually those producers say, hey, we can't eat this cost because our profits are getting, screwed. And so we have to pass it along. And so there's this kind of chain reaction that's like a 6 to 9 month chain reaction from whenever oil prices finally come down to where we see the end of inflation. And so, for a lot of people out there, they might be saying, yeah, prices at the pump are a lot higher, but we're not really seeing it everywhere else yet. It's coming, assuming oil doesn't come down very, very quickly, and likely it's too late at this point already. So I think that's something that I would just make everyone aware of, is that it's not like an instantaneous oil falls to $60 a barrel and there's no inflation left. It still will be passed through. And one thing that I hate about the system is that once producers raise prices, generally they're not lowering prices, right? We see this at the pump, right? Where oil goes up or gasoline goes up and it'll go up overnight, But then when oil or gas comes down, it takes months for that price to creep back down. And I do worry about that as well, the stress on the consumer.
Energy inflation transmits through producer margins first, then locks into consumer prices long after headline oil stabilizes, creating a lagged squeeze on real incomes. As Gareth Soloway points out here, the 6 to 9 month pass-through cycle means inflation is structurally sticky even after commodities peak. That asymmetry between rapid price increases and slow price relief erodes purchasing power quietly over time. If oil remains elevated across multiple months, inflation doesn't peak, it embeds.